Hey guys, it's Ryan, finding a path to financial freedom for the self-employed. It's that time of year again, and if you aren't already, it probably won't be long until you're freaking out a little bit, just like I am, about what's to come. That's right, it's tax time. Taxes for self-employed people can be incredibly complex, so over a handful of videos, we're going to explore a number of different issues that affect us. We'll do this in hopes of saving some money and making sure that we're more prepared when Uncle Sam comes a-knockin', but also to become more confident and reduce the anxiety that commonly surrounds tax season. In this first video of many, we're going to talk about how the feds are looking at cryptocurrency. We'll figure out what you'll owe, if you owe, and revisit some concepts discussed in prior videos to make sure that you're handing over the right information to your tax professionals when the time comes. Are you ready for this? Stay tuned. Tax time is one of the most stressful times of the year for many a self-employed person, but like it or not, it's time to get our houses in order and try and make sense of the mess we left in the wake behind us last year. For the responsible among us, maybe the stress I feel each year is a foreign concept, but for many of us who are just trying to hold on month to month, the fear we experience this time of year is palpable. More people than ever invested in cryptocurrencies last year. In fact, 10% of all Americans, or about 33 million people, invested in crypto in some way, shape, or form in 2021. All U.S. taxpayers are required to report their crypto activity to the IRS and state tax authorities, including sales, conversions, payments, and related income. The reason is that in the U.S., crypto is considered a digital asset, and it's treated similarly to assets like stocks, bonds, and other capital assets. In the same way that those assets are taxed at variable rates as either capital gains or income, the rates at which they are assessed will depend a lot on how you acquired your crypto and how long you've held it. Before we go any further, a disclaimer. I need to say out loud that I am not a tax professional and as such do not provide tax advice. This video is for entertainment purposes only, and how entertaining it will be is entirely up for debate. Talk to your tax professionals before making any decisions based on what you've heard here or anywhere else for that matter. To understand if you owe taxes on your crypto, you must consider first how you used it in 2021. Depending on what you did with the crypto you acquired, your transactions could be considered either taxable or non-taxable. How do we know? Non-taxable transactions, in the eyes of the feds, first include buying crypto with cash, then holding it. In this case, buying crypto and holding it isn't considered a taxable event. Rather, taxes are assessed later when you sell or gains are realized. Next, let's talk about gifts and charity. Crypto transactions to qualified tax-exempt charities or nonprofits are considered not taxable in the sense that you may be able to claim a charitable deduction. Further, if you give crypto as a gift, you can give up to $15,000 per recipient per year or more to your spouse without paying taxes. If your gift is more than $15,000, you'll likely need to file a gift tax return, but generally speaking, that shouldn't amount to any new current tax liability. A little gray area here, but if you transfer crypto to someone, outside of a purchase for goods and services, it could still be classified as a gift, even if you didn't mean it that way. Finally, transferring crypto to yourself. Moving crypto between wallets or accounts is a very common practice, and while it may complicate matters like keeping track of your cost basis and acquisition date, you can transfer both of those things along with the crypto to assess tax impact when you eventually sell. So where taxes are concerned, as an extension of buying and holding crypto, the where you hold isn't nearly as important as knowing when and for how much you bought it. Now that we've covered how not to be taxed on your crypto, let's talk about when you are going to be. Like before, how you used your crypto in the prior year will determine how you will be taxed this time around. First, and maybe the most obvious, is selling crypto for cash. If you cash out your crypto holdings at a price higher than you bought them for, then you're going to pay tax on the gains. The amount of tax you pay will be determined by the length of time you held the crypto. Short-term tax rates will be assessed on holdings less than 1 year old. Long-term rates will be applicable for anything held longer than that. Conversely, if you lose money or experience a capital loss, you may be able to deduct that amount from your current tax liability. For a more in-depth primer on this stuff, check out my Capital Gains for Beginners video. I'll leave a link below in the comments. Next, whenever you convert your crypto to another currency, in the eyes of the feds anyway, it is seen the same way as selling your holdings for cash. Essentially, when you swap coins, let's say from Ethereum to Solana, you're having to sell your Ethereum first in order to buy the new asset. It's not a straight trade, and for this reason, the IRS considers this a sale. therefore it's taxable. If the asset you convert is worth more at the time of the conversion than your cost basis, you'll be responsible for capital gains in the same way as if you had just sold out of the asset altogether. Finally, what happens if you spend your crypto in commerce? Much like the prior examples, if you use Bitcoin to buy a pizza, you'll probably owe taxes on the transaction. To the IRS, despite some technicalities, spending crypto isn't any different than selling it. You need to sell the asset prior to exchanging it for goods and services, thus it's subject to capital gains. Now, I know what you're saying. What if Tesla accepts Doge and I pay in Doge? Do I have to pay capital gains? I mean, I'm just moving money from one Doge wallet to another Doge wallet. I didn't actually convert it or sell it. The short answer appears to be yes. The IRS sees crypto more like a type of property than a currency, so if you receive crypto as payment, you'll pay taxes on its current value, and as the seller of said currency, if you depart with it and it's worth more than your cost basis, you'll be taxed on the difference. I would love to be wrong about that though, so if somebody smarter than me has a different take, put it in the comments below. The last category of taxable use I'd like to cover is when crypto can be taxed as income. This of course means that you're taxed on the value of crypto at your ordinary income tax rate, just like any non-crypto income you report. Examples of this include first, when you are paid in crypto or accept it in exchange for goods and services. In the event you are paid by an employer in a cryptocurrency like Bitcoin, just like a regular fiat currency, you would pay tax on that currency according to your tax bracket. We've seen examples of this in the NFL, notably with New York Giants running back Saquon Barkley accepting his salary and all marketing income in the form of Bitcoin. Further, if you accept cryptocurrency as a form of payment for goods and services, it too will be considered income in the same way traditional currency would be. This is confusing to me as the feds seem to be having their cake and eating it too. Either it's a currency or it's a property, right? But I guess when they make the rules, it's somehow both. Next, if you're mining crypto, you can expect to be taxed on your earnings at fair market value, often the price, of mined coins at the time they were received. One note though, if you're mining coins as a business venture, it will be taxed as self-employment income, and you may be able to take deductions against your equipment, internet access, and other expenses as a function of the business. Less common but still notable taxable streams of crypto income include earning staking rewards, dividend or interest type returns, the proceeds from a hard fork, airdropped currency, and other incentives or rewards. In each of these more obscure categories for the average crypto investor, the value of the currency received will be taxed as regular income. So while the crypto may have been free in the first place, given as a result of an airdrop or giveaway, or because of a rebate or dividend for investing in a specific coin, Algorand for example, there are no free rides when the IRS sees opportunity, so count on coughing up a little extra dough for those things as well. So did we save money on taxes? I don't know, maybe? By knowing better how and when to use our crypto, we can certainly make decisions that will save us money in the long haul. But don't think for a second we're getting away with anything. If it can be taxed, it will be, and the feds don't take kindly to evasion. Just ask Wesley Snipes. Thanks so much for watching. Obliterate the like button if you haven't already. Also, click to subscribe and hit the bell to be notified every time I drop a new show. If you find this content or anything on this channel valuable, share it and spread the good word. Get $10 in free Bitcoin when you buy or sell $100 or more in crypto at Coinbase using the link below, and join me here every Tuesday and Friday for more. Have an amazing day, and we'll see you all next time.